All right. Well, I'm really excited to be moderating this panel, and we have a very diverse set of backgrounds. So I'll get started having our panelists introduce themselves, and then we'll get right into the questions. So, Elodie, could you get started?
Hello, everyone. Good afternoon. Can you hear me okay?
No, the sound.
All right. 1, 2. Okay, this one is better. Hello, everyone. Pleasure to be here. My name is Elodie Demarchi, and I'm Chief Operating Officer at Kaiko. If you don't know Kaiko yet, we're the leading digital asset provider of market data analytics, so data with more intelligence, and indices. We serve only a B2B client base, working mainly with institutional grade data products and services. So all of this in a GAAP IFRS compliant rates to value digital assets. We work with 60% of the regulators worldwide. So think of the CFTC and other regulators in different jurisdictions. And also Bloomberg, Fidelity, and other institutions. Pleasure to be here.
Hi, my name is Sofia Lopez. I've been in the blockchain and digital asset space for almost 10 years now. Originally was at IBM and helped start the IBM blockchain platform business and launched the first managed blockchain service in the industry. And then over 6 years ago, left to start Kaleido. So we're a technology platform for blockchain, digital assets, NFTs, et cetera. Always focused on enterprise. Today, we work with over 40 banks, organizations like SWIFT, the World Bank, and others, and cross-industry, although more than half of what we do is in the financial services space.
All right. Thank you. And Gil?
Hi, and I'm Gil Rosen, president of the Stanford Blockchain Accelerator. I've been in the distributed compute space for 15 years before blockchain was really a thing, and then kind of have been in blockchain since 2016. I built 2 companies in the distributed compute space and have been kind of investing and advising since the Stanford Accelerator basically incubates teams coming out of the Stanford ecosystem, so that student and alumni teams. We've incubated about 50 teams so far. 90% have raised from reputable funds, 80% launched into post-revenue. So our aim is to really support blockchain founders that are driving blockchain adoption and have like real go-to-market and viable go-to-market.
Great, thanks. And my name is Silvia Sanchez. I am with the legal team at Owl Labs. And specifically, I am the project manager of Owl Explains. We are an initiative that aims to deepen the understanding of regulators around the world on blockchain, Web3. And today we've been hearing a lot about regulation, and we still have a lot of work to be done. And this explains why we do what we do. So before diving into today's panel, we've noticed that as the technology and use cases, strategies involving digital assets are constantly evolving, so are the approaches that key stakeholders are adopting to navigate them. So we will hear from the market infrastructure side, from the trading side, and also from the commercial side. But before diving in, because a big part of what we do at Owl Explains is explaining the technology, myth-busting, and making sure that we really understand what it is that we're trying to regulate. I want to get started with Gil, if you could be the owl that explains a little bit of this ecosystem.
Sure. So, I mean, it's a very broad ecosystem that has kind of many different parts to it and use cases, and I think that's where a lot of confusion often comes to, especially on the regulatory side. Right, so we've got like fungible and non-fungible tokens, and on the fungible token side, we have things like cryptocurrencies themselves, so your Bitcoin, your Litecoin, Dash, you have your meme coins, your Doge, etc. But beyond that, we also have like real world assets, which is anything from everything that people have been speaking about, I think, for the last few hours here. So whether it's securitized commodities in one way or another, whether it's credit and financing, whether it's energy or carbon credits. And then lastly, we have utility tokens, which these are tokens that are meant to incentivize use of a platform or players within a platform itself. And that's usually parties that are providing computing infrastructure or internet infrastructure or some sort of service that needs to be provided. And then on the non-fungible side, again, we have like physical real-world assets. This might be private equity. Loans are probably more useful here. You have kind of art. You have digital assets, such as different types of IP and music, through even health records. So that there are a lot of different types of currencies and tokens here that we're referring to. And I think as we look at regulation around them, it's easy to throw out the baby with the bathwater, and it's important to think about what it is that we're specifically trying to regulate and how many of these are actually analogous to things that we currently use in the real world today, whether it's trading cards or Airbnb and the like.
Great, thank you so much. And I like what you mentioned that tokens are not a homogeneous asset class. And I think that's a key point in regulating them, which is classifying them sensibly, understanding that they're not all the same thing. They all have different functions, different features. And I'm going to switch gears a little bit to talk about the market infrastructure and data side. So, Elodie, what key trends have you been seeing lately around here?
Yeah, absolutely. I'll try to make it simple and to anchor this on like 3 different points. The first one being around the changes that are inherent to the new different requirements coming up with some of the accountant standards. I'm sure if you're in the US, you may have heard of FSAB. If you're in Europe, you may have heard of like DAC 8. Not talking about MiCA and other regulations. The regulatory framework is going to change the way you operate. So we've talked a lot about policy changes and legal requirements. There is one other thing that's important to understand when you navigate the digital asset space is all of those requirements have a direct operational impact. What we are seeing in the market as a data provider is that we're seeing a convergence towards traditional finance standards. I think the previous panel was talking about MiFID, MiFIR, and others that you probably know very well in traditional finance. We are also seeing an increase in terms of reporting with DAC 8 and FSAB. Now you need to report on the fair value of digital assets. We're going through like a transition year in 2024 with everything effective in 2025. So definitely, when you operate in the system, you need to have the right partners. You need to like get more maturity in your operating systems because the way things were working before will not work anymore in different jurisdictions. So that's number one is really, like we are not in a mature ecosystem yet. However, we're getting there thanks to some of the regulatory framework that's being put in place. And also thanks to the adoption by institutional player. We heard of like all the ETFs coming into play, all of those large players coming to way to operate that they are used to in traditional finance. So that's the point number one. The point number two is the importance of data. So I think for those already familiar with data in traditional finance in a Web 2 environment, data is already extremely important. In a Web 3 environment, data is even more important. Why? Because when you operate within smart contracts, you don't have like this middleman to actually, be a buffer. Once you have information, when you have a price going into the blockchain to liquidate your portfolio, this will work, if you have a programmability into your smart contract saying like once Bitcoin hit 50K, then you liquidate your portfolio, that information is super relevant. So the accuracy of the data is extremely important. If you have watched the news recently, you may have seen some fake news. Oh, ETF are approved. No, actually not yet. You may have seen some price manipulation, wash tradings on different exchanges. So high quality data, accuracy is something that we work towards. It's extremely important to work towards more maturity of the ecosystem, and that's extremely important to get to the next phase. There is another thing with data is sometimes that you don't realize that data is everywhere. Pre-trading activities, you need data for market surveillance. That's why we work with regulators. When you do trading, there is still a highly fragmented segment between centralized and decentralized exchanges. You also need data to have a complete view of the ecosystem. Post-trading activities, I talked about fair market value. I talked about valuation of digital assets. Today, there is still no central bank in the world that will tell you, oh, that's the price of an asset. So you need to go through, I would say, highly trustworthy partner to give you IFRS GAAP compliant rates that you can use within your operations. There is one third point. So I talked about first, the increased maturity that we're seeing in the system. I talked about the importance of data. The third part is interoperability. That's a word I'm sure you've heard plenty of times in the past couple of years, but we're not there yet. And Sandra, you pointed out, in the previous panel, it's true, like there is still some challenges, the lack of maturity of the infrastructure. For example, how do you on-ramp and off-ramp liquidity? There are still some challenges like with stablecoin, with like a lot of the banks that it's hard to actually find a partner, financial partner that will accept you to get your money on and off. Today, if you look at the prices, that's one of the things we do quite well. You see that there is actually very little liquidity in Bitcoin. Bitcoin price has gone up by a lot. Went up from like 85% since October, but you see a lot of liquidity and instability. So one thing to get there to navigate the digital asset space, we'll need to find a solution. Good thing I'm super optimistic person to start with. Second thing is when there is demand, you will have an offer. So even if we've seen last year some of the Silvergate networks and others really making it more challenging to onboard liquidity. Now that you have ETFs, 1.4 billion is hard to avoid, and more basically investors. I'm sure there will be some new offers, but that's still a question really to answer in order to bring in more liquidity and to contribute to the maturity of the ecosystem, which will come along the regulatory, framework, the new reporting, more accuracy and more trust within the system.
Fantastic. Thank you, Elodie. And now I'd like to go over to the commercial side with Sophia. And I want to ask you, what major developments have you noticed lately that have made you rethink your approach to digital assets? How have they changed your outlook specifically?
Sure, thanks. Well, I think piggybacking on the maturity thought, I've been in the space for almost a decade now, and it's interesting. There's a law around technology, new emerging technology that called Emra's Law. We tend to overestimate the impact of a technology in the short term and then underestimate it in the long run. And it's really around that 10-year mark when you sort of have that you flip over to where now it's just really accelerating. And I was reflecting before the panel, in the early years, everyone was really excited on areas such as asset tokenization and thought this is just like a killer use case for the tech. But it's taken this long now for sort of, the financial markets, financial players to really wrap their arms around it. And then, if you look at all, like BlackRock and many others have been talking about tokenization over the last year or two. We actually, as Kaleido hosted a panel, at a number of panels in New York as part of a workshop and a series of events on asset tokenization with a lot of the major financial players in New York in the fall. And it was a common theme that people said it's just inevitable. So I think one of the earlier panelists, Andre from Brazil, I think was saying central banks, there's a FOMO around central bank digital currencies. Just overall, even for private banks, global transaction banks, it's almost a reputational risk if they don't have something that they're doing in the asset tokenization space, the digital asset space, because their wealth management groups, they have clients who are asking them, what is your point of view? What are you doing? So we definitely have seen an acceleration in the space. I mean, we work more broadly across lots of different types of digital assets, but for an example, in the central bank digital currency space, we're working directly with over a dozen, central banks. So it's quite interesting seeing the different models that are emerging, and then directly with a lot of private banks and other players. So we see that there's asset networks, and then assets and networks are really almost two separate approaches. If you're, a natural player who launches assets in industry, things are a little bit muddied now because people might be spinning up a network as part of getting their asset to market. But I think over time we'll see more of that delineation of, the players who are bringing forward the digital assets, and then these larger networks. Like one of the organizations we work with is Swift, and now we're running phase 2. They have, almost 40 banks who are involved now, and 4 different types of use cases. They're quite interesting. I know they're going to be wrapping that up and writing a report, but that's a great example of a network play. Or another one that's really exciting in the industry, is MasterCard. So you're looking at payment processors and saying we need new rails, which I think Ronit was talking about. It's just another rail. And how can we help with on and off ramps? So they had launched a multi-token network earlier this year. And I think all of those, when you see the network approaches to just what is this new world of digital assets going to look like? What is our role going to be in there? A lot of CSDs have been doing quite interesting things like DTCC and others. And then the various players who are coming forward more with assets, and then the markets and exchanges around that. And then I think the other point you made around interop is quite interesting. I do think the technology's evolved quite a bit. The Swift project I mentioned, they're actually using 3 different types of blockchain protocols. And we like to joke the 3 they picked are quite popular in the enterprise space. As technologists, we'll say you almost couldn't have designed different technologies if you tried to as a goal. So being able to then have asset and cash networks across different currencies that are involved in different assets, and then do the interoperability between that, just shows how much the technology has really matured over the last decade.
Great overview, thanks. And now let's go to the trading perspective. Let's go to Gil. What have you observed lately at the market? What is happening? What have you noticed up close?
So there's, I sit in an interesting place because I get to see like what people are building, and kind of what's the next wave that's coming, but also who's funding them and what those financial interests are. I think to date, most of the 3 cycles that we've had generally been driven by hype of one way or another, one sort or another, whether it's ICOs, whether it's DeFi, DeFi summer and NFTs. But the fundamental value behind it was always like a step behind because the tech wasn't actually mature enough. So while there is certainly some speculation still in today's markets of, oh, the Bitcoin halving is coming, or people that are trying to move money out of Russia and China, I think for the first time there's a combination of both institutional adoption and regulatory clarity that we're seeing across much of Europe, Japan, Hong Kong, Korea, the US to some degree. So kind of like the regulatory clarity, which is making institutions much more comfortable with delving into real world assets and the like, but also the technology itself is for the first time ever in a place where I think you can actually build viable applications that are performant, right? So we've solved the scalability problem with various layer 1s and layer 2s. We've reduced the cost to negligible gas fees. We've leveraged account abstraction and the like to make these applications actually usable. We have like robust dev tooling, which makes it easier for people to build. So for the first time, like in the last 6 months, we're actually able to build viable applications across a range of different sectors, and we're really seeing this. So right now, when people are raising money, they're raising money for projects that are actually viable, that have customers that are alive. And I think that's significantly going to affect the trading ecosystem because I hope it will be more based on actual fundamentals rather than just speculation.
Good point, thanks. And now let's go to the group because I think it's quite evident that regulators, institutions, companies are noticing a big increase in this digitizing of the world's asset, but navigating this requires a complex strategy, and I think that's easier said than done. And about this strategy, what unique challenges have you seen in digital assets that make it that create this inconsistent regulatory treatment around? Like, what are these specific nuances that you think need to be addressed right now? Sophia?
Yeah, I mean, I probably for regulatory, maybe I'm not the best expert here. I'm more on the technology side, and then just actually real traction, real world use, which I do have a comeback to your statement, but I'm saving it up for the right question.
I can start on that. I think, I mean, there is something in Europe called, talk about, MiCA and MiCA 2.0. There is still one thing that still need to be, very streamlined is the definition of digital assets. When you go into like security token and others, it's not extremely clear yet what's, how do you define this? There is still a lack of standardization also across the different group and jurisdictions that need to happen. So those are still challenges today that companies face to. It's really good. We have like a foundational layer. Now we need to build up on it and refine it. And I think that's a challenge that still exists and we'll need to go through in order to bring more stability and clarity.
Well, I'm going to ask you. I heard from a group of lawyers in a workshop I was in that some of the new regulations in Europe actually place some liability on developers of smart contracts. So that's pretty interesting if you're in the public space and you think everything should be like atomic settlement and it's all programmable and there's no central intermediary. So a developer being liable for that is quite interesting development. So I don't know if either of you have any thoughts about that.
It's very interesting. So yeah, that's something we're starting to think about. Is basically when you think of like the traditional exchanges, right now in the Euronext and other places, you already have regulations on that. And what is an exchange? I mean, at the end of the day, you already have a lot of technology and it's all regulated in a very strict way. Mm-hmm. So basically, when you think of programmability and actually having, should you regulate a line of code? Mm-hmm. Isn't it the case in some ways already? So it's a question I'm asking you now.
Yeah, I mean, my feeling was this is still, even though it's written into the regulations, it's an active line of discourse between the lawyers who focus on digital asset space, and it might not continue in its same form. Yeah. So it's being actively debated.
Yeah, I think you bring a really good point, though, of there's a difference between a protocol that is just launching that still has, to some degree, ownership and control versus one that is like completely de facto open sourced. And how do you define kind of if it's an open source project and everyone's contributing to this project, is the specific person that contributed this bit of code. Like when it's a protocol is more mature, such as like Uniswap, for instance. So yes, Uniswap Labs is managing much of it, but not like it's open to everyone. It's a DAO to propose changes. So yeah, it's interesting if someone in an open source project, it's like if someone writes something on Wikipedia and they get sued.
Yes, and to this point, how do you consider that the digital assets community in general can contribute to generate this positive change, that in a way that doesn't stifle innovation, but that it protects users while it continues to incentivize the development on all borders?
Well, I mean, I think there's different constituents in a digital asset community. So I'll take the perspective more of like enterprises or banks, central banks who are doing real projects. And we heard earlier from the head of digital assets at UBS, it's all about ROI and real outcomes. So I think what I've seen is stimulate a lot of interest globally, are projects like the Central Bank of Brazil. Now, they launched this instant payment networks PIX a couple of years ago. It's been widely successful, very well adopted. Now they have Drex, which is their central bank digital currency. And, they're going through, a journey with pilots now, but they had the initial target to go to production by the end of this year. So it's not like they're doing an experiment, they're stopping and then doing another experiment. They want to go all the way through, and it's a top 20 economy. There's 16 sets of banking participants with consortiums. In some of those sets of participants, they have hundreds of banks basically involved. So everyone is really looking at new digital asset rails, other layer 2 or other solutions as well they could build on top of that to connect wholesale tokenized deposits and other new products and services they could launch. So I think in the digital assets landscape, when people see what others are doing in other jurisdictions, they look, take some of those use cases and ideas and say, oh, we could do DVP differently. We could do conditional payments. Here's ways that we could use this to solve problems we have in our financial ecosystem and our economy. And then, of course, there's, the cross-border questions as well. But I think that seeing real projects, driven by real entities, I think is what I think really moves the space forward significantly. And I did want to counter, my perspective, I think, Gil, you're thinking about public blockchain technologies sort of coming of age to where you could do real projects. I think in like the more of application-specific chains or side chains, permission consortium, and there's one remittance network that's been in production for 6 years now, and that's in the Philippines, and there's hundreds of banks they themselves are unbanked because they're not connected to SWIFT. So there's a lot of these sorts of uses of the technology that have been in production and are very, they're compliant. You have to have SOC 2 and ISO 27K. There's different types of compliance or central bank approval for cloud workloads or things like that. But they've gone through all those hoops and they have, product that's been providing a lot of ROI and benefits to their target users.
You're 100% correct. And in the 16, 17, 18 cycle, the real winners were kind of private consortiums and your Hederas and others that were, and Stellar that went after, and Ripple that went after like private consortiums. And you're 100% correct in that.
Yeah, but I agree. Like today, we're really looking at a whole spectrum of approaches all the way to like fully public. And then there's, different interop with like application-specific chains, like at Avalanche Subnets, for example. They've really focused on the institutional space. So it's really a lot of enterprises are looking at hybrid approaches and where the value is and what makes the most sense in areas like regulated DeFi, quite exciting to the financial sector.
Absolutely, great. And a big part of also like what we do within Owl Explains with the Owl Labs, you were mentioning all the challenges, but what would your message be to regulators, both from the trading, from the commercial side? Like, what is that thing that we're missing that is the top of mind priority right now? From the different perspectives you represent, like what is that key thing that regulators need to address?
Well, we're back to regulators. I'm just reflecting there's different types of regulators. So if you're thinking about, the future of money and stability of economies and currencies, reserve currency, the way the public sector interacts with the private sector, I think you have a certain set of maybe regulators more focused on that sector than maybe a regulator who's looking more at like trading or exchanges. So I don't know if you have a point of view more on the regulators that you interact with more.
Yeah, we work with several regulators in different jurisdictions in the US, in Canada as well, in the US, in the Middle East, in Europe, and now also in Asia. And there is one thing, that they are starting to look at, and I think we can only encourage them, is to look more into the data. I mean, you need like both. You need a macro view, and then you need more, like specific view. That's how we have been, working closely with them. In terms of macros, you need to look at what's happening in the ecosystem. You need to look at what's happening in the markets. What's the price of an asset? What's the volumes you are seeing? And you need to have this macro view to be able to identify some fraudulent activities. And once you identify a fraud, basically you can work with, a chain analysis or like another provider to really look into like what's happening and look under the hood and see, identify like who's behind this. I'm thinking of the FTX hackers and others that you can have. So that's one thing, is to, have this look at like as a regulators to be able to do market surveillance and understand exactly what's happening, to be able to identify and, prevent fraud. That's the first thing we recommend. The other thing is more education. I feel like there is one thing that we have seen in the past couple of years is that regulators are very curious and they are looking to understand more. We're also seeing more understanding on like what's happening on chain. So not only what's happening off chain, which is more similar to traditional finance, but we're also working with regulators into a fashion where they're understanding what's happening on chain. If they don't have that expertise in-house, they look at partners or others, but they definitely have this will, and we can only encourage them to understand what's happening on chain, because when you think of the, both components, you have everything happening on-chain and off-chain, and you cannot exclude one of the other. It's a combined view, and it's going back to what I was mentioning, talking about interoperability. You can talk about this in several aspects. You have interoperability between TradFi and, digital finance, which is super important. If you cannot transfer value one way or another, my personal view is that we won't be able to do like, this big promise of Web3, blockchain, DLT related technology is really a promise of exchange of value. You can only get there if you can have like this bridge between traditional finance and Web3, in my opinion. So talk about interoperability between TradFi and digital finance. And then within digital finance, everyone knows of like what Coinbase is doing, and they're not the only one, to do more bridge between DeFi and CeFi. And I also think we need to do more of that.
And I just want to add, like, I think the replication of TradFi in DeFi is incredibly great for the industry as a whole, because TradFi is something that regulators seem to understand, and it's like, okay, we have a new, more efficient and effective way of having kind of these open standards for digital infrastructure that allows for, in theory, interoperability. I think the challenge is that all of these kind of open platforms need to run on these underlying blockchains, and regulators don't understand how they work and don't understand the tokenomics models and what that actually means and how that should be regulated. So then we have this kind of middle area where you can't actually, or in order to launch or replicate TradFi on DeFi, you need to have validators who are kind of earning rewards, and you need to have staking, and that's not necessarily the same as earning interest. So I think there's a huge educational aspect of it, of first gaining legitimacy and trying to replicate as much as we can from TradFi into DeFi, but beyond that, then just really educating regulators on, well, this is actually the underlying technology and what's happening. It's not just gambling. Let's set the gambling aside. Like, these are actually people that are doing actual services by running compute platforms and running protocols.
Great statements. I like those main things, looking at the data, making sure there's interoperability and the educational component. And I think they can be synthesized in understanding the technology, and that also comes along with breaking the myths, kind of what we were mentioning on the initial part of the panel, and then classifying the token sensibly. And from there is that we can actually enact that context-appropriate regulation and thinking globally, like we can't just have one set of regulation here, but then completely different thing over here. And I think like from the commercial side, that would really like affect the kind of flows of trade. So I think that thinking globally and making sure that there is a harmonized set of regulation is something that we continue to work for.
Well, I did want to, I've been calling out examples of great projects. I mean, one of them, I think, getting to the working with regulators in education is the Regulated Liability Network. So it's a unified ledger type approach at Citibank, and a variety of others, including the Innovation Lab of the Federal Reserve was involved in their phase one. So really educating by doing, and then just standing up these networks, talking about the benefits, and then sort of the pros and cons of the technology. I know Tony from Citi, I he was at the Digital Dollar Project event in DC a month ago and was talking about sort of provocative question is, what would it take for public blockchains to be ready for banks to use? And he said, well, we can't transact with sanctioned entities. So if we don't know who the validator is or who's on the other side of that, that's a problem for us. But there's still a lot of benefits that are, they're surfacing and highlighting as part of this unified ledger approach. I know BIS, Daniel was on earlier, and they've done a lot of great work as well, both with like unified ledger as well as like, atomic settlement and other liquidity management, AMMs, et cetera.
Absolutely, and I think it's interesting that you mentioned the Digital Dollar Project, because in fact, just last week we sat down with Chris Giancarlo, and that was the exact same point that he mentioned. I think it's still something that requires a lot of work to be done, but I think this is a year in which we will continue to see how this continues to develop. And now that we just have a couple minutes left, I wanted to, leave this space either for questions from the audience or just any closing remarks that you would like to make to wrap up the panel.
Maybe ask if there's any questions first.
If there's any questions from the audience before, or... Okay, we have one from the back.
One brave soul.
Sorry. With Swift moving and converging with blockchain, can you speak a little bit more about that? I know there are a lot of folks who are native to crypto who cringe at that thought. Sure. And do you think it's a good thing, honestly?
Yeah. Well, I mean, I started a company where we provide flexibility and choice and lots of different technology options, and we're sort of working with the market as a technology partner. So I normally... I'm not weighing in on whether something's good or bad, but I think lots of different models are being tested and emerging. And in their case, they did have a report for their phase 1 project, so I encourage you to look at that, and phase 2 is just wrapping up now. But really, I think they were looking at a real problem in the market, which is you have over 100, according to the Atlantic Council, over 100 countries who are looking at CBDCs. How are you going to do the cross-border transactions after they have their own national CBDC established? And they're saying they're a nonprofit collaborative association of all the major banks. They're ready in this sort of role where they help with messaging. Is a way they could help connect between the CBDC ecosystems. And when I look at what they're doing, and some of us are really excited about the potential for what these technologies could do for the future of money and the way the industry's been moving. If you have someone who already has market trust and market permission, who's stepping up and saying, hey, we'll work with you. I mean, the second phase, they had doubled the number of participants because people are excited about exploring this. So I think... who's it for us to say, what's the best approach forward? I do think that people are seeing value in it, and they're moving forward with the industry. They're not taking a point of view and saying, that's prescriptive. They have weekly working groups around the use cases they want to explore, where are the biggest pain points, and they're very responsive to all the people who are participating in the project. They actually have, a lot of other people who are observers as well and not actually in the project. So I think the Web3 ethos from, the early days is like, let's do something together as a community. We're trying to use these technologies, to solve problems and help our world function better. And I do think it checks a lot of those boxes.
Yeah, I completely agree. I think the more we adopt these technologies and the more we have kind of these open standards that are used and allow for more people to kind of integrate with these systems, the better, as opposed to more closed systems. One other thing that, just on the regulatory side of things, I think we're far away from it, but with the advancements in ZK kind of proving and validation, I think it's actually an opportunity to potentially have blockchain perhaps be legislated at some point as, like, if you need to prove that you are doing something, right? So we have Sarbanes-Oxley, which is supposed to be compliance standards by financial institutions, that this is the code that you're running. But if you can actually prove that that's the code that you're running and that you have it maliciously, or that someone hasn't, either by accident or maliciously, changed it. If we think about, like, the AI models that are going to be proliferating throughout every application that we have, how do you know what model is actually running if there's bias that has been inserted into it? So I think like these are the types of things that ZK can really help with, where you can prove that you're running a model, you can prove that it was trained on this specific data set and doesn't have this type of bias. So I think if we can make allies out of regulators, that'll be a huge leap forward.
All right, and looking that we're almost out of time, I just wanted to thank you all so much, and we could continue, with the conversation, but also just a quick comment before finalizing. We are always open to talking to people from different perspectives. We've heard from the trading side, the commercial side, the market infrastructure side, and obviously the regulatory side. So if you see us around, just feel free to say hi, because we'd love to connect with you. We're always open to hosting new people on the Owl Explains podcast. Keep the conversation going. So thank you to our panelists, and thanks, Paul.